Hello, everybody. So today I wanted to spend a little time discussing the last quarterly earnings for Google, Amazon, and Apple. Indeed, they have reported their earnings this evening, and you can see that really the growth is really not that good. And of course, they accuse currency movements and things like that. But it doesn't get anywhere near my threshold for stocks. When I look at stocks, I want stocks to grow at least at 30% a year in terms of revenue growth. And so looking at Google, well, Google was 1% revenue growth year over year. Okay, cloud is doing much better, but cloud is a teeny tiny segment of their business, Google Cloud GCP. So that doesn't even move the needle because this company is so big. And why are they so big? Well, one of their hallmarks is, they have 9 products with more than 1 billion users. How much bigger can Google get? Let's look at Amazon. Amazon, famed company, lots of good stuff going for it, especially thanks to AWS. They have the number one infrastructure as a service, cloud service. They have a number one service. The whole company. I guess it runs e-commerce as a charity on the side. That's a joke. I'm being facetious, but it's one of the main reasons why you buy Amazon is because you want that growth from AWS. And even with that, and with all of a side business and retail, they only have 9% year over year, 9% year over year revenue growth. And how much bigger can they get? How much can they grow? They have about 38% of all of the U.S. e-commerce that goes for Amazon. Could they reach 50%, 60%? I doubt they could go any higher. They are already the number one search engine for stuff. So Amazon is a very big company at 9% year over year. Now let's look at Apple. Apple's even worse. We're kind of, in the computer semi-company, so they have some cyclicality, especially with the iPhone. Some people call Apple the iPhone company. And Apple is down 5% year over year with a slowing sales of the iPhone. And they kind of have this cyclical sales cycle whenever they introduce new models every other year. So, essentially flat revenue for Apple, minus 5%, less than flat. What do? Well, they have a lot of success, 2 billion active devices. How many more devices can they get? And they're buying back their stock. They bought $25 billion worth of stock just this quarter alone. So that's what Apple does. These companies do not grow very fast. But they've nonetheless had really good returns, like really decent returns between 2010 and 2023. You can see about 23%, 26%. Google, my data only goes back to 2014, so but 24%, almost 25% a year. So really good returns, nothing to sneeze at. But keep in mind, many of these returns were achieved when these companies were still growing really, really fast. It seems like the growth is slowing down. So here's my take on stocks like Google, Amazon, and Apple. To me, these stocks are what I call sound value stocks. And they are value stocks. When you look at revenue growth of 1% for Google, 9% for Amazon, and minus 5% for Apple, and you take them as a basket, you have a value company that's barely growing at a pace, higher than inflation. They're not growing much. That's hardly any growth, And how could you grow? Google has 85% of the market share in search in the Western world. YouTube is the number one streaming platform, right? Amazon, again, that number is much higher. It's much higher than 38%, for example, in certain European countries. In a lot of places, Amazon's doing really, really well in e-commerce, and they're already the biggest cloud business out there with AWS. How much more can it grow? Apple has 2 billion devices. How much more can it grow? Realistically, the maximum amount of customers, if you remove kids and if you remove the elderly, realistically, if they were to conquer the whole world, they could get 5 to 6 billion possible customers. So that's like a 3x at the max. And it's not, it's not reasonable to expect that. So it's tough for big tech to move the revenue needle when you own so much. But let's compare this. Let's compare these stocks to the newest kid on the big tech block, right? Who's the newest big tech company, in my humble opinion? That's Tesla. Tesla had year-over-year growth of 55.6% revenue growth. And when I look at a company like Tesla, I'm like, okay, they are. Last time I looked, it was about 3.3% of all of the vehicles sold in the U.S. were Teslas. So under 4%, right? And they are still not in every country. We haven't penetrated every other countries like they have the US. And so Tesla still has plenty of foreign markets to enter, plenty of new products to be introduced. And so can Tesla, like any good tech stock, reach 1/3 of its market, right? Become have a market share of 1/3 or more. Can they do that like any good tech firm does? Can they sell 1 out of 3 cars in the world be a Tesla? Is that possible? I would argue it's possible. And if so, that would be a 10x for Tesla from the current stock price. So when I summarize, 10x is not possible, at least in the foreseeable future, for any of these big tech firms, whether it's Google, Amazon, or Apple, right? Much lower margin, much lower average sales price for example, Apple products. These are transactional businesses, transactions on retail, transactions on ads. So again, smaller total addressable market. 10x doesn't seem possible. To me, when I look at Tesla, we're aiming to disrupt the second largest consumer good that one can buy after a home, which is a car. That's what they are going after. To me, when I look at Tesla, I tell myself, well, 10x is feasible. The 10x is feasible on Tesla. They would need to have 1/3 of a market share roughly to 10x based on my back of a napkin, very simple calculation. So Tesla still has plenty of growth. These companies don't have too much growth left in them. They just don't. And so let me move on quickly. How do I look at these stocks? Google, Amazon, and Apple. And I actually own Google and Amazon. I have positions in Google and Amazon, more Google than Amazon. I don't own Apple. But I look at these stocks as inflation-edged savings account. I believe they will only slightly exceed monetary inflation going forward, assuming they keep doing a 20% CAGR. Or even less. And that is because in this channel, I assume that the US dollar devalues at about 15% a year. I assume that they are going to keep devaluing the US dollar, that the Fed is bluffing. And so since they devalue this US dollar, you really have a possibility of return at 20%, 20 minus 15, that's 5%. You technically have possibilities for about a 5% real return. Right, and I'm not too far off. Like, let me look at the past 5 years. Like, when I look at Amazon over the past 5 years, they've returned about 11, let's call it 12% average return. When I look at the compound annual growth rate of the money stock over that same period has grown at about 9%. So you do 12 minus 9, you're at about 3% return for Amazon. So that is very, very close to what you would get in a savings account, except at this time it's in real terms. So it's much better than a savings account because it's in real terms. If you had a savings account yielding 1%, in real terms, you would be losing 8% in that setup. So big tech here is obviously much better than actual savings accounts. But I think an even better way to look at it is to look at big tech, these three firms, Google, Amazon, Apple, to look at them as a good parking spot for money, a good parking spot for money that you can add to and remove from depending on the fluctuations of higher growth stocks. And I think they're good parking spot for your money because they're one of the safest ways to match or slightly exceed the growth in money supply. When you buy big Google or big Apple or big Amazon, right, big tech, you buy a fixed share of a slow growth monopolistic empire. And I expect that big tech will perform in line with other scarce assets like, say, a single family house. With owning big tech, you actually own a share of a desirable worldwide asset, like a search engine, like an online retail platform, or like a next generation computing platform like Apple, for example, and phone platform. So you buy a share of a monopolistic system, and that share hopefully is going to stay about the same, or the weight of that share is going to grow as these companies do buybacks, and you're going to have growth that most likely matches our growth in GDP and our growth in the economy. These companies will grow at the pace of the economy. That's why I call big tech sound value. It's sound value because you buy a tech monopoly, and you buy a tech monopoly that is immune to disruption, much more immune to disruption than other types of monopolies. Why? Because these monopolies are fairly new. And because they're fairly new, there's constant reinvestments in the brands, in the technology that is required to stay on top. That's why when you look at it, even Amazon and Google don't pay a dividend yet, because they keep reinvesting in the brand and striving for that growth, as little as that growth may be. You have a lot of customer satisfaction and incremental innovation going on. These companies are not asleep at the wheel. They are led by great business leaders who are all about making the customer happy. Right? In the case of Amazon and Apple, very much so, and also Google. I would argue most people are very happy with their Gmail service, their YouTube service. So they focus on things like customer satisfaction or innovation, which is something a lot of other types of monopolies fall asleep at on the wheel. They're not asleep at the wheel, these big tech companies. And you get buybacks and dividends, for example, for Apple, whenever possible. And sometimes, oftentimes these buybacks just adjust for stock-based compensation. But in other times, you have more buybacks than stock-based compensation, and that's when you actually reduce share count and make your ownership of Apple, Amazon, or Google even more valuable because you reduce share count. So buybacks and dividends play a role in keeping that sound value. That's why I would put them in this category. And let me show you just two random stocks that I don't think have been doing a good job at sound value. If you look at 3M, or if you look at GM, these companies have been, GM went bankrupt, but if you forget about that as a second, they've both been around for 100 plus years. They are both value stocks by very definition. And they've both been, in leading positions in their market. For GM now, they're a little in trouble because Tesla's here, but 3M is still in a leading position in its segment of the market. And when I look at the return, there's no way you beat monetary inflation. When monetary inflation has been at 7 to 8% during the same period and is now at closer to 15%, these companies have only returned 5% and 3%. So you're losing money by owning this type of monopoly. So if you're going to own a monopoly as a savings account, I believe Google, Amazon, and Apple will do very well and will play their role as good savings for your future and my future, because I have a little bit of those. So thank you so much for watching. This was not investment advice. This is just entertainment and edutainment. Please like, please subscribe. I really appreciate any subscribers I can get. Thank you very much and have a wonderful day. Thank you.